Most people think of insurance as a product. I don't. Insurance is a data business that just happens to sell protection. And in a world where prediction is everything, from what you'll buy to when you'll break, data is the difference between companies that price risk and companies that become one. Now that's the story everyone tells, but here's the truth. 25 years after the dot-com boom, most insurers still can't get two systems to talk to each other. When insurers get data right, everything changes. Claims that took 11 days now settle in 3 hours, thanks to AI triage. Parametric weather insurance pays out instantly when a rainfall sensor trips a threshold. Personalised motor coverage adapts dynamically to real driving behaviour. Data doesn't just make insurance faster, it makes it relevant. And yet the vast majority of the industry still treats it as an afterthought. Structured data is the clean, consistent, machine-readable stuff. Policy numbers, claims amounts, timestamps, sensor readings. It's what your systems can analyse automatically. Unstructured data is everything else. Emails, adjuster notes, PDFs, call recordings, drone images. And here's the catch. Unstructured data makes up 80% of what insurers collect. When we say insurers struggle with data, we're not talking about missing it. We're talking about not being able to use it. When data isn't structured from the start, when it's trapped in PDFs, emails and legacy formats, it becomes impossible to move smoothly through the value chain. From broker to underwriter to claims to reinsurer, every handoff becomes a translation exercise. The result isn't inefficiency, it's lost intelligence. The global insurance industry generates 2.5 petabytes of data every day. Yet according to McKinsey, less than 5% of that data is used in decision making. 5%. Meanwhile, maintaining legacy systems consumes 70% of IT budgets, and only 21% of carriers have cloud-native cores. It's not that insurers don't have data, it's that they can't digest it fast enough to be useful. Most insurers still run on mainframes written in COBOL, a 65-year-old programming language still used in 43% of core insurance platforms. Data gets trapped in silos, pricing, claims, policy, reinsurance, all separate systems. So when a claim is filed, the data that could prevent the next one sits idle, undiscovered and unliked. In a data economy, latency is the enemy of intelligence. That's why the most progressive carriers are rebuilding their foundations, not just adding analytics on top, but replacing the plumbing beneath. A handful of leading players are getting it right. AXA has built a global data platform linking pricing, claims and risk engineering data across 30 countries, cutting loss ratio variance by 12%. Zurich uses predictive analytics from its risk advisor platform to prioritise inspections, reducing property losses by 20%. Allianz launched its Data at Core initiative to unify 400 plus systems into a single architecture. Munich Re runs a data fabric integrating Internet of Things, satellite and weather feeds for risk modelling at a global scale. Ping An in China uses real-time customer data to issue life policies in under 60 seconds. Deloitte estimates that insurers adopting native data architecture can cut operational costs by 25 to 30% and improve underwriting accuracy by 10 to 15% within 3 years. The winners won't be the ones with more data, they'll be the ones who can make it flow. When data flows properly, clients stop feeling processed and start feeling understood. Underwriting becomes consultative, coverage becomes contextual, claims become conversational. Instead of static one-size-fits-all policies, you get adaptive protection driven by data, but experienced as empathy. To the client, structured data feels like respect. It means you remember them, not just their renewal date. But let's go one layer deeper. For most clients, insurance is the least loved product they own until they need it. So what does good feel like when nothing goes wrong? It feels like peace of mind. And that's what structured, client-centric data actually delivers. When your policy is built around your behaviour, your assets, your life, and not just your postcode, it feels personal. The customer isn't buying coverage, they're buying confidence. According to EY's Global Insurance Consumer Survey 2023, 84% of customers who felt their policy reflected their individual circumstances reported high satisfaction, compared with just 42% of those who said that their insurer didn't seem to know them. That satisfaction directly drives loyalty. Accenture's 2024 Customer Pulse found that personalisation based on data increases policy retention by up to 25%. So the better your data, the more peace of mind you sell, and the less your product feels like a grudge purchase. In the absence of a claim, data is the proof of care. And this isn't just operational hygiene, it's capital strategy. Every improvement in data flow reduces uncertainty. Less uncertainty means lower cost of capital and greater risk-bearing capacity. That's how information itself becomes liquidity. In other words, insurance doesn't run on money, it runs on data. Money just catches up later. So the next time someone says insurance needs to modernise, remind them it doesn't start with new products. It starts with structured data, flowing, connected, trusted and shared across the ecosystem. Because until the industry starts to learn to digest what it already has, all the talk about AI, innovation and transformation is just noise. I hope you found this helpful. If you have, please consider subscribing to Risky Business, and I'll see you in the next one.